Welcome back to week 4's lecture 2. So in this lecture, we'll figure out how to price any kind of asset. For example, think about a house or a computer. Such an asset is a commodity that provides a flow of services over a period of time. A financial asset is just a special case of the general definition of asset or general class of assets. A financial asset provides a flow of money over time, which we called as financial security in the last lecture. Typically, asset values are uncertain. Incorporating uncertainty takes a little bit more of concepts and tools than what we have up till now. So, right now we will study assets assuming that we can see the future with perfect certainty. Let's think about when should an asset be sold. So we have tried to see what is the maximum that you would pay for an asset given the income stream that it is going to generate. Now the question is, you have an asset, when should it be sold, or whether you should just keep on holding to it. Usually people would say that you should sell the value of the asset when the value is at maximum so that you make maximum profits. However, the answer that we will get after analyzing an example asset is no. And we will show now why not to do that. So let's say that the value of an asset changes with time. Any value of an asset changes over time. The way it changes is given by this equation. So, what is this equation? It basically tells you how the asset price varies over a period of time. So, if you're talking about the first period, at the end of the first period, then the value of the asset is basically minus 1000 plus 1000, which is 0, minus 10 into t square, which is just minus 10. Okay, and so on. How does the graph of this asset look like? So, if I put different values of years, then I will get this kind of graph, which is a concave graph and tells you that the price of this asset rises, but it rises at a reduced speed or at a decreasing speed. And therefore, the value of this asset has to have a maximum point. And here, after visual inspection of this diagram, we can see that the maximum value of this asset is at the end of 50 years. So, if we decide to wait till 50 and sell this asset, how much are we going to get? Now, the maximum value of this asset occurs when the curve basically flattens, or we can figure out a point where after that point the curve starts going down, and before that point the curve is going up. So mathematically, a tangent at this point has a slope of 0. That's exactly what we are finding out here. So this sign is basically of the first derivative. And as many of you would know, a derivative is a technique to find out what is the slope of a given function. The way to find out the slope of a given function at the point where it is maximum, we know that slope at that particular point is 0. So we basically figure out a derivative and equate it to 0. Derivative of 1000t is 1000 with respect to t. Derivative of 10t square is 20t. And a constant doesn't change, so its derivative is 0. Therefore, the total change that we are going to look at is 1000 minus 20t, and at the point where it becomes maximum, the slope has to be 0. What is the present value? The max value that we have, what is the total value of the asset? The maximum value of this asset at the end of year 52, as we can see from the diagram, is 24,000. Now, understand that the rate of return in year T is the income earned by the asset in year T as a fraction of its value in year T. So that's basically the percentage gain that we are trying to calculate. So example, if an asset valued at $1,000 earn $100, then its rate of return is 10%, which is 100 divided by 1000 multiplied by 100. So suppose the interest rate is 10%, then when would you sell this asset? You will sell this asset when the rate of return to holding the asset falls to 10%. Then you can just keep the remaining money or whatever amount you get from selling the asset in the bank and continue earning 10%. So let's do that calculation. The rate of return is whatever you're going to get at the end or at time t divided by the total value at time t. In our example, Vt is given by this expression, V prime t is given by 1000 minus 20t, which is equal to 0 because the slope has to be 0 at that point. When I calculate the rate of return, which is the rate of return, which is the total, which is the amount that I'm going to get in period t divided by the total amount, then this is what the expression is. And the asset should be sold whenever this expression, which is the rate of return on the asset, which is simply the amount I get in period t divided by the total value in period t, is 0.1. That is, if I solve this expression for t, then I basically get t is equal to 10. So you should sell this asset at period t, at the end of the period t, if the rate of return is given as, or rate of interest is given as 10%. Now, does that really make sense? Because we saw here that the value of the asset is maximum at the year 50, and the maximum that you're going to get is $24,000. And how does it make sense to sell the asset even though the asset's value is only $8,000 at that particular point? What is the payoff at year 50 from selling at year 10 and then investing the $8,000 at 10% per year for the remaining 40 years? It turns out it is going to be 362,074, which is way more than 24,000, which you would get if you wait till the year 50 for the asset to reach its maximum value. So, the time at which an asset should be sold is determined by the rate of return, or the rate of interest that is promised to you by a competing asset. So, let's say that you want to buy a house purely for keeping it as an investment. Now here I'm using the word investment as from finance point of view. Then you should hold on to that house till the rate of return on that house falls down to what you would get, say, by putting money in a 3-month government security. That would be figuring out what is or when you should sell the asset, and that also tells you what is the price of an asset that you should be paying for when you want to buy. So this idea of using a comparative rate of return to decide whether you should keep the current asset or not is termed as arbitrage. Arbitrage is trading for profit in commodities which are not used for consumption. So, for example, buying and selling stocks, bonds, or stamps, or even assets like houses. If there is no uncertainty, then all profit opportunities for any asset would be found. What does this imply for prices over time? The price today of an asset, let's say, is P0. You want to buy a house, let's say the price of the house is $300,000. Let's say that we expect its price to be something else tomorrow. Now, even if this is world of certainty, prices would change depending upon demand and supply, the condition of the house, and so on. But in a world of certainty, you exactly know what will be the price tomorrow. The question is, given P0 and P1, should you sell the house right now? Well, let's figure out. The rate of return from holding this asset would be whatever price you're going to sell it minus the price that you paid for it divided by the price that you paid for it. So let's call this R. So basically, I can figure out P1, or I can express P1 as P0 multiplied by 1 plus R. Now here, because I'm selling, I'm going to sell the asset tomorrow. Now, what is the alternative that I would have done with this P0 instead of buying the house? Instead of buying the house, let's say I would have bought a bond which is sold by a government, or I would have just paid or put my money in savings account in a bank to earn interest at R. Therefore, if I do that, then tomorrow I will have P0 into 1 plus R. Now arbitrage tells you you will sell the asset depending upon whether you are making profit or a loss on this asset, and here profit or loss is calculated as a difference between the price of the asset minus price of an alternative that you would have followed if you did not buy the asset. So, when is not selling best? If the rate of return on house is greater than the rate of return on, let's say, an alternative asset, which is, let's say here it is savings account, then uh, you basically should hold on to the asset. If the rate of return is lower than the bank account, than the rate of interest that you are going to get in your bank account, then there is no point in holding on to the asset. You would be better off by selling the asset and putting your money in the bank and earn the rate of interest R. So sell P0 whenever this condition is satisfied. So people will buy, there will be some people would sell. In equilibrium, obviously, every asset would sell at the rate of interest, or the return on every asset is going to be the rate of interest that the savings account gives you. Hence, for every asset, today's price P0 and tomorrow's price P1 satisfies this equation. That is, we can express the price tomorrow as whatever amount you paid in uh, year 0 to acquire the asset multiplied by the rate of interest that you would have gotten if you had put that money in the bank. This equation gives us a convenient representation. How much should I pay for such an asset? Well, clearly, today's value is P1 divided by 1 plus R. I'm just solving this equation for P0. Then today's price is the present value of tomorrow's price. So let's look at bonds and figure out what is the arbitrage in bonds. So bonds pay interest. Yet when the interest rate paid by the bank rises, the market price of bonds falls. Why? Clearly, a bond pays a fixed stream of payments of X dollars per year, no matter the interest rate paid by the banks. At an initial equilibrium, the rate of return to holding bond must be the rate of return on the bond equal to the rate of interest on a savings bank account, the initial bank interest rate. If the bank interest rate rises, then obviously the new interest rate is greater than the rate of return on the bond, and the bond should be sold. Sales of bonds would lower their market prices. Hence, the rate of interest that you get on the safest asset and the price of the bond are negatively related to each other. What about an asset whose return is taxed versus an asset whose return is not taxed? If T is the tax rate, then the no arbitrage rule says that whatever rate of return you get after tax on this asset should be the same as the rate of return you would get on an asset which is of which the return is not taxed. So the after tax rate of return should be equal. Therefore, the rate of return on the asset that pays you tax is nothing but the rate of return on the asset which is not taxed divided by 1 minus t, which is the tax rate. Financial intermediaries basically price assets depending upon what is the demand and supply, and they facilitate trades between people with different levels of impatience. Patient people who save lend funds to impatient people who are the borrowers in exchange for a rate of return on the loan funds. By ensuring that these two people save and they can engage into a beneficial intertemporal exchange, both groups are better off. All right, let's stop here. Uh, Please attempt the quiz after this lecture, which is basically the quiz 2. And then we will enter a little bit of complicated area where the rate of return on an asset is uncertain. Thank you.